Welcome back to the Chiro Money Show, where we help chiropractors make better financial decisions so they can build stability in their finances and a lifestyle that they love. We're your hosts, Chris Shield and Scott Campbell with Align Wealth. Welcome back.
How are we doing today, Chris?
Doing good, man. Doing good.
Yeah.
Yeah.
It's been a busy stretch.
Yeah, we're almost over, almost through it.
We've had a really busy 4 or 5 weeks of what we refer to as our winter meeting with all of our clients. We have these meetings throughout the year, and we happen to be in a heavy meeting season that we're the lights at the end of the tunnel. Not that that's a bad thing, but getting everyone through that process, it's always great because you get to check in with all the clients. They have things on their mind that they want to talk about, and it just brings up great discussions and great questions. And a recent discussion from a meeting we had a couple of days ago sparked the idea for the topic that we're going to dive into today.
Yep, it sure did. Yep. Yeah. It's been busy, but awesome. We love seeing everybody and having this kind of surge style meeting calendar and schedule, but it does make for some busy months. So yeah, I'll jump right in and share the story that we'll dissect and kind of base the conversation on today. So client we were meeting with, fairly, I would say, advanced, like experienced investor, been investing for a while, quite an established net worth. And they, beyond their awesome, balanced, diversified, boring portfolio that does everything we want it to do, they wanted to take on a little bit of exposure to some other alternative asset classes. In this case, we were talking about gold and Bitcoin specifically. Whatever those things are, I don't think it really matters. This could be used as a discussion against like buying an individual stock or anything like that.
Yeah. We're not here to debate gold and Bitcoin today.
We are not getting into Bitcoin. That is for sure.
No, not today.
Not for today. Anyways, the question came about, well, how much exposure should I have? And the client wanted to basically make a decision based on what had happened recently. And we kind of pushed back a little bit and referred back to a previous conversation we had with them where we thought we had established a pretty solid framework of like how much exposure to these alternative assets that we wanted to have. In the client's mind, though, maybe wasn't as clear cut. And so essentially they were using their logic to try to make the best decision in that moment. And whereas we were trying to refer back to a decision-making framework that would guide the decisions on how and why we're invested. And it was really interesting. So going through this, it was like, well, we kind of touched on our key philosophies and beliefs, principles around that guide our investment philosophy, which
we're going to get into today. We're going to go through what our guiding principles, we call them our guiding principles to a philosophy around investing.
Yeah.
We think it's important. We're going to get into why having an actual philosophy and almost like a mandate of how and why you're invested is so important for a successful investment journey.
Totally. Excited to dive into those. So we did at the beginning of this meeting with the client, we did a quick review on those. We're like, we remember these. We still believe these. We're all in agreement that like, this is what drives us. This is how and why we invest. Everybody's like, yep, 2 thumbs up. Let's go. And then 20 minutes later, we're talking about Bitcoin and gold and increasing our exposure. And we're like, hold on, wait a second. Does this still hold true to the 6 guiding principles that we just discussed?
Yeah.
And that basically drove us to the point of having a collective decision that we need a clear written mandate of how and why we're invested so that we can refer back to it. I think it's especially needed. I think everybody should have this, but especially in cases like this where there's something beyond the normal happening. Just to refresh everybody, our normal is the boring, balanced, globally diversified, owning 15,000 stocks across the world. That's the boring. That's what everybody should have, we believe, as a starting point for their investment journey, where we want to get fancy along the way and play maybe with 3 to 5% or less of your total invested assets. Maybe you want to do something sexy with that because you're bored or because you believe something about the future.
whether that's Bitcoin or holding commodities like gold or silver, or having a little self-directed account where you want to have some play money where you individually pick, buy and sell individual stocks. We've talked about this on previous episodes. If someone wants to take, like you're referencing, maybe 5% of their portfolio and go make some speculative investments, we think that's okay. Like, we all have different desires around investing about what we want to do. Some of our clients are like, I could care less. I do not want to do any of that. Like, let's just buy the global diversified portfolio and set and forget it. We'll focus our time on the things that do matter, running my practice, living life, that kind of thing. But we do have clients where it's like, okay, if that's something that's important to you, let's factor that in. If it's only 5% of your portfolio, and say it's Bitcoin, for example, if it does go to zero, we know the rest of your financial plan is going to be intact. Where the story got interesting with this particular client was like, all right, if we're agreeing on maybe a 5% exposure to Bitcoin, what happens when, like, again, we're not trying to debate whether it could be any asset class, but let's talk about what happens if Bitcoin goes, call it, to the moon, and the value of Bitcoin goes up 10x in the next year. Inherently, that means that your exposure is going to potentially go from 5% to 12 or 13 or 15% potentially, right?
20%, 30%,
20%,
who knows?
doesn't matter.
Yeah.
That's
what
where
do you do then?
That's where the conversation with this client got interesting. Well, he was saying, well, I view Bitcoin and gold a little bit differently than the rest of my investments. It's a hedge towards certain things. Government's printing money like crazy, yada, yada, like all these different things of the reason why he might view those assets differently than the rest of his portfolio. Well, the question then we kind of posed was, well, what happens if it goes to, if Bitcoin's now making up 30% of your portfolio? Today, you say 5% exposure is fine, but what happens when it goes to 30%? Is there going to be some sort of rule of thumb or a mandate or a guideline to say, well, if that part of my portfolio goes up, I need to rebalance or get back to my mandated guidelines of being at 5%. And that's where we had some interesting conversation around, well, I don't think I'd go back down to 5% necessarily. Maybe I'd take the money that I invested initially and take that off the table and get back down to maybe 13 or 14. The key word that I'm putting in there, Chris, is maybe I'll do that. If it goes really low, I don't know if I would sell more of my portfolio to get it up from 1% back to 5%. This is where we started to be like, well, we're going completely against some of our guiding principles that initially you said, like, yeah, this all makes a lot of logical and rational sense for having a mandate around how and why we're investing.
100%. You have to keep in mind that when we refer to investing, we're always speaking about long-term investing for your financial independence, long-term. It's supporting you in those work optional years for maybe 30, 40 years. Like, even someone close to retirement still has a 40-year investment time horizon. A young person just starting out probably has an 80-year time horizon, maybe if they're 20 now. The principle that I love that you brought it back to in that conversation was, well, if you're happy with 5% now, if 5%'s the goal now, like, why would we ever change from that? Why would we ever deviate from that?
Exactly. That's the point that we're trying to drill home in this case. We want to take the maybe out of it. We want to take the guesswork out of it. If we should shift probably gears to kind of these mandates and these principles that'll help shape. Maybe we can come back to the story here and tie this all together here at the end. But yeah, maybe we should shift gears.
Let's do it.
Kind of go through what our 6 kind of guiding principles are around investing.
Okay, you do the first one there, Scott.
First one is market timing. We are never going to tell our clients when to get in or out of the market, either as a whole, or try to time when to get in or out of certain sectors or countries or asset classes. We believe time in the market is so much more valuable than time in the market. We've talked about this on previous episodes for sure, but trying to guess when to get in and when to get out, it's a fool's game. No one can do it consistently and get it right over a long periods of time. You might get it right once. Like you said, someone's time horizon could be somewhere between 30 and 70 years. Do you have faith that we can time the market on the tops and bottoms? If it was that easy, everyone would do it. But there's a lot of evidence to say that just it can't be done. So let's just get in the market, set it and forget it.
Yeah, it's so interesting. It's like, why do we lose common sense when all of a sudden we're talking about investing? Because I think inherently we all know and believe that no one can successfully predict the future. That's what market timing is trying to do. you're trying to predict the future. So if you believe that you can market time, well, you should be a billionaire. Like if you can predict the future, like what do you need to invest for? You should have everything you could ever desire. But we know that people can't predict the future. So why would we try? Yep. Dive into the next one here. Point two, principle number two, global diversification. Yeah, there's probably nothing more important than this. The world stock market is built up, is made up of companies across many different countries. So here we're in Canada. Canada makes up about 3% of the world's market. If you're investing only in Canadian companies, you're missing out on exposure to 97% of what's happening out there.
Mhm.
And we don't have to look far. We can look just across the border to our neighbors to the south, and their economy, their stock market is built up of completely different companies and sectors and assets that we don't have access to. They have a huge amount of private healthcare companies that people invest in. We have so much oil and gas and banks. That's what makes up Canada's stock market. But you go other places and you get access to different things. Yeah. So having that access across the globe and as many companies as we can, that's principle
Yep,
number two,
for
global
sure.
diversification.
One thing I'll add to that, and the reason why we want that diversification is that these companies around the world based in different countries, they perform differently at different times. Like in recent history, the US stock market has done exceptionally well over this last decade. There was a period of time in the 2000s where it was the Canadian stock market where people were like, I don't want to invest anywhere else aside from Canada, right? And that's kind of been the trend with US. But then if you just look back at recently this last year in 2025, it was the Canadian stock market who had an exceptional year. So we're not trying to guess and use recency and history, like recent history, to say that's going to guide our decisions of how we're going to invest from a global diversified standpoint here moving forward, because we need to understand that it's going to have there's going to be these ebbs and flows in terms of what countries and what sectors and what asset classes are going to generate returns over the decades ahead. So let's just own it all in a big diversified basket. Hey, before we keep going, if you've been listening and thinking, I could really use some clarity around where I truly stand with my finances, we've got you covered. Take our free financial clarity assessment. It only takes about 5 minutes, and you'll get a personalized scorecard showing exactly where you're strong, where you might be spinning your wheels a little bit, and where to focus next. You can head over to alignwealth.ca or just hit the link in the show notes. All right, cool. Back to the show. All right, what do we got for point three, Chris?
Keep costs low.
Why is that important?
Well, investment fees, they compound just like returns do, right? So if we're consistently paying too high of investment management fees, that's eating away at our returns year over year.
Yep.
And we've already established that market timing and predicting the future is a fool's errand. So we don't need to pay an active manager to try to do that fool's errand. We should just not have an active, like that style of active approach, which typically lowers our fees considerably, just going from an active to a more passive approach.
Yep. And just as a refresher, why people typically would pay a higher fee, 1, 2, upwards of 3% in some cases, in terms of a fee on the fund that they're invested into, is that typically that higher fee is correlated with paying a fund management team to actively try and buy and sell the different stocks with inside a fund to outperform the broader market. But there's so much evidence to say over long periods of time, 10, 20 years, the odds of someone trying to actively manage a fund and outperform the broad market, it's a losing game. The stats are close to 95% of the time, the passive, boring approach is going to outperform an active manager. Those odds aren't great, right? There's no problem with paying a higher fee if you're going to get good value and there's going to be consistency that, I'd pay a 2% fee if there's evidence supported that I could get a higher expected rate of return by doing such, but that's not the case.
Yeah, unfortunately, that's not the case. If you could pay a higher fee and guarantee a higher return, I think everybody would sign up
Sure.
for that. But there is simply no one out there that can guarantee a return. And that should be a red flag. If you ever hear that, if any of our listeners ever hear that, someone trying to guarantee a return, like you should turn and run.
Yep, for sure.
Okay, next one, my favorite one, faith in the future. I mean, I think this is pretty intuitive in some ways. Like if we are not optimistic about the state of our world and what we have looking ahead of us, it's pretty hard to be a long-term investor. And that can be hard actually though, in a lot of cases. If we're watching the news and following the media and what's happening in the world, there's so much doom and gloom and negative publicity across the world, not just in financial news, but everything, right?
Yep.
But
A lot of
what
pessimism out there right now.
so much pessimism always, anytime in history, right?
It's true.
But what I like to think about with faith in the future is if we're a long term investor, you are invested in companies. Stocks are just a fancy word for companies. Companies
Yep.
exist to provide a product or service to a consumer like you and I, and they are hoping to make a profit in doing so. If you are a shareholder, own shares, stocks in that company, you will be rewarded with some of those, a share in that profit. Despite our currency concerns about printing money, despite our global wars or political agendas or whatever, do you believe that real people across the world will continue to be innovative, entrepreneurial in nature, build awesome companies that provide products and services to consumers and reward their shareholders? I know I believe in that. I find it hard to find a world where that wouldn't happen.
Even the scariest of times, right?
Totally.
COVID happens, a pandemic hits. If you step back, like, sure, this is like, it's hard. It's hard in the moment. There's a lot of headlines in the news. It's scary. People are getting sick. Like going back to that time, for example, there's uncertainty and it's hard to discount uncertainty. But if you could step back and say like, yeah, like you said, do I have faith that we as mankind will get through this scary scenario? We will innovate and get through this. We'll find a vaccination or whatever the case is. Like we'll get through this, right? People will continue to show up at their businesses, provide that good or service for a profit. Might not look great in the moment, but long term, things will turn back around.
Yeah.
Right.
And that's exactly what happened during COVID is everybody
quite
went out
quickly.
and innovated.
Exactly.
The world changed as we know it.
Yeah.
It was scary, but if you
Yeah.
stayed invested throughout that, man, you were handsomely rewarded.
For sure. The world changed. Things were, like you said, innovation happened. You know, the stock price of Zoom went up and Peloton and these other things that skyrocketed during that pandemic time frame. But
I'm sure glad I was focused on that and not buying toilet paper.
absolutely, for sure. Yeah. All right. Next principle is such a big one, and I'll circle this back to this conversation that we had with this particular client, and that's just tuning out the noise. We are inundated, like you said, with primarily bad news. Primarily, it's very pessimistic in terms of what's in the headlines. You know, I think back, like we talked about, this time last year in 2025, February, March, April, so much uncertainty, so many negative headlines out there that made you think that you need to do something with your long-term investment portfolio. There's action that I need to take. And I'm sure there's a lot of people who took action and regret that action because 2025 turned out to be a pretty positive year in the markets overall. Again, it's so hard. Like it's all hindsight. There's uncertainty. There's these negative headlines. You feel like you need to do something to take action. Yeah, that's probably it's harder said than done. But ignoring those headlines and not even letting them come into your feed is probably a good place to start. Would you agree?
Definitely. I think these last two are so connected. Faith in the future, tuning out the noise. Like they're kind of, like if you're staying on top of the latest news, that's so much of that news and what's happening in the world is going to be at direct odds with maintaining faith in the future. So it's really important to tune that out. And I think that actually reflecting back to this client conversation, like I think when we reviewed these two things and specifically, I think that kind of our client opened up their mind to this in a new way and just thought like, yeah, okay, I know there's worries, I know there's concerns, but right, I'm going back to the tried and tested and true, invest in companies, globally diversified, maintain faith in the future. And for whatever reason, Bitcoin is the future, you've got some exposure. Great.
Yeah, for sure. What's the last one, Chris?
Last one, probably the most important one, managing our behaviors. It's probably the hardest one too. It's how do we respond or react when inevitably things get scary?
Yeah.
because that will happen. Things will get scary. That's mostly related to market corrections or crashes.
Yeah.
We know that those are inevitable. That's a healthy part of the economy, of the economic cycle of stock market. If you're a long-term investor, you should expect to go through many crashes in your investing journey.
Mhm.
What was the stat? I'm trying to remember, Scott, but I want to say something like if you're invested for 50 years, you're going to, on average, see about 6 or 7 crashes.
Yeah. At
Does that
least
sound about right?
typically every 5, 6, 7 years, like that. That's just based on averages over history. But yeah, you're going to go through 6, 7, or 8 potential major market downturns over a 50 to 60-year investment journey, easily,
So it's
right?
how we respond when that happens that is
For
going to
sure.
have the biggest impact on your personal rate of return.
Yeah,
Because you can be in the best portfolio, balanced, diversified, the right exposure, but you can make one wrong decision and that can cost you 40% return.
yeah, for sure. And the flip side goes too on like when things get really, really good, or you get very, very excited about, markets are doing great, or a certain type of sector or investments doing really well. You get the old brother-in-law in the ear saying that you need to invest into XYZ because everyone's doing well, and you have FOMO. You don't want to be left behind and be the schmutz who didn't invest into that particular, I don't know, pharmaceutical company that you ought to be invested into because they're doing big things. And that goes part in hand with like, just tune out that noise and then manage the behavior, being like, thanks, brother-in-law. I appreciate the advice, but
Yeah.
good luck
Yeah.
to you.
It's like we're almost meshing a couple client stories here now. We
Yeah,
had
for sure. They're
another one
weaved in.
recently that the client had a single stock holding for quite a long time, and it was just at the advice of family and friends, and all few members of his family are all invested in this one company.
Mhm.
And yeah, there was never in his mind any reason to sell, because what if it went 10x and he was the only one that didn't have it? But interestingly enough, in our last meeting with him, we were talking about future goals and plans and aspirations, and he had this future goal he shared with us. In this case, it was acquiring like a camper van, like a pretty fancy camper van, and being able to kind of live out of that and spend a lot of time outdoors. Like, I think the way you posed the question, Scott, just like crushed him, because you were like, would you rather have a few shares in this silly, whatever this is, healthcare company, or would you
Yeah.
rather have the camper van? It's like, damn,
It's going to
yeah,
bring
this
you
is
more joy.
stupid.
Are we living
What?
life to hold a couple shares in a pharmaceutical company that might generate you a great return? If it did, great. Like, is that going to make a huge, is it going to change your life? Probably not. I sure know that camper van is going to change your life. The memories and experiences that you're going to have with your family in it. Like, basically, it's like, sell the stock, dude. Go buy the camper van. You're going to get a
Yeah.
lot of fulfillment out of it.
He came back 3 days later and was like, yeah, I'm ready to sell.
That's right.
Yeah.
That's right.
Yeah,
Yeah.
it's good stuff.
Yeah, I think, going back to our initial story with that client and why we thought we'd weave in these principles in this conversation today is that at the end of the day, we need to have a philosophy. We need to have almost like a mandate. We almost thinking like, is there a reason to have your philosophy and your mandate written down? Like, you write down, here's how and why I'm invested the way I am, so that when things go crazy, good or bad, or things come up, like I want to invest more into Bitcoin or gold or into NVIDIA, whatever, you can reflect back to why you started your investment journey to begin with. And is there good enough reason to shift away from that mandate? Right?
You don't need it in writing until you need it in writing.
That's
And
right.
at that point, it's too late.
You can't put it in writing at that point.
No, it's too late at that point, right? It's the same as having like estate documents in place. It's like an insurance in place. The time to get them is when you don't need them. When you're of sound mind, when you're making, when you're just kind of at the right stage to make an educated decision.
Yeah.
That's when you need to do these things.
Not an
when-
emotional decision.
Exactly, not emotional, a rational decision.
Yeah, for sure. Yeah. Yeah. We're all rational human beings until something happens. Then we go crazy.
Yeah,
It's just natural human tendencies, right?
for
So
sure.
yeah, that's, I think it was a great reminder for that particular client to kind of be like, all right, well, if you believe in these principles, this makes rational sense now. then let's apply these same principles not only to our globally diversified portfolio, but also let's find a mandate around, all right, if you want to own a little bit of Bitcoin or gold, great. Let's support you in that. Let's make sure that's a reasonable amount from our standpoint, from a big picture planning standpoint. But hey, if Bitcoin goes through the roof, we want to tune out the noise. We want to manage our behaviors. We don't want guesswork and maybes to come into play here. We can just say, all right, well, December 31st of each year, I'm going to look at my Bitcoin exposure. If it's gone up from 5% to 9%, I'm going to sell some of my Bitcoin to get back down to my 5% mandate. Zero emotion. Move on with my life. Carry on.
Yeah.
That's the outcome.
Doesn't require you to watch the price of Bitcoin every day for the full year.
For sure. He still will.
Maybe.
Yeah.
I think, like you said, to kind of wrap up, or as we get close here, like the question I would pose to our listeners is, do you have an investment philosophy? First of all, do you have something that you believe in that you can clearly, concisely communicate? It should be simple. It should be easy to communicate. That's where you got to start with. Can you write it down? That might be hard, but again, if your philosophy is simple, which it ideally should be, you should be able to write it down. And then, is it actionable? Is it something that you can reflect back on? Yeah, it could change over time.
Mm-hmm.
Maybe there's different iterations of it and you update it annually or every 5 years or something. But ultimately,
you're probably doing those updates and those changes with maybe new information, but from a standpoint that you're making a rational, logical decision to say, there's a good reason to change my mandate for the following 5-10 years, for example, rather than like an emotional reactionary mandate change based on headlines.
I would argue that if there were to be changes to the mandate, it would more often than not be due to personal circumstances changing than market conditions changing.
Yeah.
If you're changing your mandate because of news or market, you don't have a strong enough mandate.
Yeah.
But if your life changes, say, sell a company, say, have kids, separation, who knows what happens, right? Those could be reasons that your mandate changes, maybe.
Or you go through a major market downturn and realize I don't have the risk tolerance that I thought I had when I first set out in this mandate. I think I need to dial like my risk tolerance down a notch because what I thought I could handle is not actually the case.
Maybe vice versa. Maybe you go through one and you're like, okay, cool. Now I know what this is like. Let's ratchet it up. Let's go.
For sure. Yeah. Cool. Any other points you want to hit on?
I just can't believe you haven't mentioned the hat yet.
The 607 and Chill Insider.
Yeah, kind of an inside joke. I don't know how much we want to get into that, hey?
That's for clients only.
Okay. We'll leave it there. You can send us direct questions if you
I do have a pretty sick Align Wealth hoodie on now, though. So
that's true.
Sweet.
Finally getting some swag.
That's right. Represent. We need more blue in our lives, right?
That's right.
Yeah. All right.
Love it. That was great.
Wrap it there.
Let's wrap it here.
Sounds good. See you next week.
See you guys next week. Thanks for listening.
All opinions expressed on the Chiro Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.